very good at talking about the potential negatives, and sort of the media is very good at covering that as well. Just to perhaps end this on a more positive note.
So wait. You have to leave the stage,
positive?
Rob.
Yeah.
I have to go to... Yeah, sorry.
Apart from an 18 to 20% inflation rate or interest rate 10 years from now, what are the positive things that you guys see for the next decade or so?
Well, actually, I am quite positive about the next decade. The issues are events that create temporary crisis, but the crisis create the buying opportunity. So I suppose maybe the better example is let's examine what has occurred not too long ago. So in 2008, a crisis occurs, equity markets drop 40 or 50%, and we own shares in a lot of very good companies that are down 40 or 50%. Royal Bank would be a good example of that. We can look at that as a disaster because luckily for diversification reasons, our clients did not feel that 40 or 50% drop. But we can look at that and say, well, wait a minute, those companies are fundamentally good companies. And now we're buying them at a price that's unbelievably good. We did that with real estate trusts. We had the opportunity with with bank shares, for example, and many other companies as well. So in a way, the idea of a crisis or an event is a positive outcome because we will always be, as will all of you, net buyers of assets. We're always acquiring assets as opposed to selling. Very few of our clients are likely to see their net worth shrink. And as a result of them being net buyers, you don't want to keep paying a higher price for the assets you already own. So once in a while, you'd like to buy them on sale. So the actual events, the volatility of the markets is actually, in my opinion, great news. You just have to have the discipline to say, we're going to buy those assets because they're distressed. That's why we're actually buying them. And then have the patience to wait for the outcomes on those assets to occur over time. And I think this future markets will continue with their volatility for all the reasons we've discussed, and that will actually make buying opportunities occur more frequently, and I consider that a good result.
You know, the other thing I would say, though, is, you know, if we look at what's happening in the Middle East and the uprisings, you know, a lot of it was spurred by technology. It's people, you know, seeing, you know, what the rest of the world has and wanting it. And I think that's extremely exciting. I think that you know, even now doing trade with China is something, you know, 20 years ago we wouldn't even thought about, and Russia. And I think you're going to open that up even more. The only countries that are able to keep that sort of tight totalitarian regime are ones that are shunning technology, and they're the ones losing out, and it's a vicious cycle for them. So, you know, I think that from a growth point of view, you know, we're at the beginning of a great opportunity. So,
yeah.
You know, we kid about it. I mean, we spend all day worrying about the risks because we're, you know, job one is to protect capital. But, you know, we're also looking at the opportunity. That's, you know, a very much part of what we try and do.
A large percentage of our portfolio that's in things like bonds, global bonds, these things are, in fact, short duration. Effectively, they're cash. Other investments that are not near cash or not likely to be affected by outcomes in equity markets, things like maybe preferred shares, in some cases, things like first mortgages. These are other asset classes, and first mortgages would be a good example. If the equity market drops 30% in the next 6 months, there's going to have virtually no impact on the value of a first mortgage portfolio. So if we decide to reallocate part of the money that's in these mortgages because the equity markets have dropped or because we see this incredible bargain from a real estate perspective, we'll certainly have the opportunity to make that decision because we just don't keep that larger percentage of our clients' money in any particular asset class. And so it doesn't mean that we need to keep stuff in cash just because we're interested in acquiring other assets.